welcome to today's webinar about real estate investing reimagined. My name is Mark Shuler, and I am the president of Shuler Architecture and SGRE Investments. Today, we're going to talk about how you can create passive income and reduce risk while using the best real estate investing approach you've never heard of. So without further ado, let's head right into the presentation. So we're going to talk about three things today. The first thing is we're going to talk about the SGRE Investments investing strategy and how you can leverage this strategy in your own investment portfolio to create passive income and outsized returns while also reducing your investment risk. We're going to talk about the types of assets that we like to invest in. And then finally, we're going to talk about our unique vertical integration business model that allows us to deliver these returns to our investors while, mitigating the risk. But before we get into that, we're going to kind of address one thing called the elephant in the room. I've spoken to literally hundreds of investors by this point, and invariably there's always a couple of key questions or concerns that come up. And I invest in deals myself as a passive investor, and I have these same kinds of questions about the deal and the deal sponsor. And typically it sounds something like, who is the sponsor and are they legitimate? Is the deal really going to perform the way they predict? So in a few minutes, we're going to really delve into that, and hopefully you can see what I'm talking about. And finally, we're going to talk about, the opportunities that we offer as an investment real estate firm. We're going to talk about what these potential deals look like, what the opportunity looks like, whether it's a good fit for you. And finally, I'm going to talk about next steps you can take if you want to get involved. But before we do any of that, I'm going to take care of the lawyers. I'm not going to read this verbatim, but want to give you the Cliff Notes version. This is not a direct solicitation for funds. This is an educational presentation only. I am not a lawyer, I'm not a tax professional, and I do not play one on TV. Again, this is a presentation that is intended for educational purposes. And if you want to learn more, you can reach out to us and we can go into greater detail in a subsequent conversation. If you want to read this disclaimer, feel free to stop the presentation. You can read it in its entirety and then start up the presentation again. So anyways, let's make sure you're in the right place. This presentation is for you if, you're a sophisticated or an accredited investor. It's for you if you're tired of the volatility that you experience in the stock market. It's for you if you're struggling with working way too many hours like I did. It's for you if you're worried about inflation. It's for you if you want to spend more time with your family, which is a big one for me. And then, finally, it's for you if you want to generate financial freedom through passive income. So, if you can relate to any of these bullet points, then, stick around. This is probably a good presentation for you to watch. Let's talk about who we are. I'm going to tell you about who I am, what qualifies me in this space, what I stand for in terms of my business practices, and then finally how I've established myself in this game. My name is Mark Shuler. Like I said, I'm president and managing partner of SGRE Investments and Shuler Architecture. I've been in the real estate game for about 10 years. I've been a practicing architect for a lot longer. I spent my youth in Detroit. And as far as I can remember, I always wanted to be an architect. After high school, did the usual thing, went to college, then I went to architecture school, graduated from architecture school, and then took the usual path that architects take. I worked for several years as an intern, took and passed my exams, got my license, started a couple of firms. But along the way, I discovered a couple of things about myself. And, the first one is that temperamentally, I'm just not suited to work for other people. I just don't like sitting at a desk doing a JOB. I've always wanted to run a BIZ. It's just how I'm hardwired. Second thing, I discovered, not surprisingly, is that I'm a serial entrepreneur and a real estate junkie. I eventually went to the University of Washington, got an advanced degree in real estate development from the business school there. And, I just love everything about real estate. It's something I am really passionate about. The funny thing is, you would think I would have figured out my sort of entrepreneurial bent a lot sooner than I did, but it wasn't until I was in my 30s that I and was running my first architectural firm that I discovered I really don't like running an architectural firm. I don't mind practicing architecture, but I hate employees. But that I really wanted to do something else. And it took me a long time to figure it out and a lot of soul searching. But, I finally figured out what I wanted to do was what I always wanted to do, which was develop workforce housing. So I kind of did a full circle in my life. My architecture essay to architecture school was about workforce housing and affordable housing. And, lo and behold, here I am 40, 45 years later doing exactly that. I just, funny how life works, but I just feel like I'm doing exactly what I was meant to do in this lifetime. So, anyways, let me finish up about myself. I'm a licensed architect in Washington and Texas. I've been practicing for almost 38 years now. I've been running my own businesses for more than 30. I am now a general partner in more than 15 syndications. These syndications are all apartments, and my partners and I now own over 3,000 units. That equates to over 500 million in assets under management. Wish I could say that all I was a workaholic, but I'm not. I am actually a master's swimmer and a wellness enthusiast. At 62, I'm in the best shape of my life right now. But more importantly, what I'm really all about in my life are my grandkids. I'm a proud grandfather of 5 grandkids now, and number 6 is on its way. Here are 4 of them. Really, these are the reasons why I do what I do in life. I could have retired a while ago and been lying on a beach getting fat, lazy, and stupid, but I'm just not wired to do that. So I really love my grandkids a lot, and it's definitely a lot of fun. I get to hang out with them 2-3 times a week, and certainly get to spend birthdays and the 4th of July with them. So, it's, I don't know if you are a grandparent or a parent, but does definitely change your outlook on life. And it certainly did for me. So, let's talk about, kind of how I do business and some testimonials here. I was raised by an Air Force officer who instilled in me a real strong work ethic and some basic military values of, trust, honesty, integrity. And I've carried those values with me throughout my life, and certainly in my adult life and in my business career. And now into the real estate game. It's something that I prioritize is honesty, integrity. I'm doing too much to tell lies and then remember what those lies were. So it never even occurs to me that I would do that. And I'm always stunned when I come across people who do that. It's just not how I'm wired. Anyway, so each of these testimonials from folks who I do business with, I'll invite you to kind of read through all of them. I think you'll see the common theme. It hits close to home with my basic values. And then full disclosure, I didn't coach these people into saying anything. This is really what they said. So again, if you want to take the time to read these verbatim, I invite you to shut down the presentation for a minute, just kind of go through each slide. The first one is my IT guy. Been working with him for a few years now. Second one is the broker who I did my first deal in life with and still friends with and still do deals with. Third one is a partner of mine on a deal we still own in Seattle. He's an interesting character. He's now a participant in 75 syndications, really outpaces me. Yale graduate and actually had a short stint in the NFL, believe it or not. And then final one is a partner who I've done a lot of deals with, Josh. We're both Michigan graduates, both engineers, probably to our core. Think a lot alike. We look at the deals very similarly, but also at the same time, we look at it very differently. I have a more creative kind of mindset and willing to really spin it from 360 degrees and look at all facets of it. Josh tends to be much more analytical. In his first career, he was literally a rocket scientist. So, do a lot of analysis on our deals, and it's just helpful to have people who can kind of really vet the deal out. So now let's talk about the thesis part of our presentation, and that is, why do we like apartment buildings? Our entire business model focuses on apartment buildings. There's a lot of different asset classes out there that we could be investing in. I know why I do it is goes back to what I've always wanted to do, which is affordable housing. But there's really a lot to like about apartments. One of the things is leverage. We like the leverage component that we get with apartments. I know a lot of people who build single family portfolios, and that's not a real scalable business. I do one apartment deal, maybe it's a 100-unit deal, and these folks, they got to go out and buy 100 houses. You've got 100 driveways, 100 roofs, 100 furnaces, 100 hot water heaters. It's just a matter of leverage for us. There's also financial leverage. Real estate, and commercial real estate in particular, is the only asset class out there that allows you to control 100% of the investment for a fraction of its price. So, most people are familiar with single family houses. If they own one, they know that they can generally buy a house with a down payment of 20 to 25%, and then get a mortgage and control 100% of that asset for that 25% investment. The same goes for apartment buildings. We do the same thing. They're typically financed with fixed rate loans. Usually leverage is somewhere from the low 70s to as high as 85 or 90%. I don't advocate doing that much leverage on a deal, but I have seen people do it. It's what provides the returns, that leverage. Another thing we like about real estate is that it appreciates, and the beauty of real estate is when you buy it, you control the cost, but then the buildings, continue to appreciate in value at that same cost. The components that go into it, the materials and the labor that you put on a project, taxes, insurance, that will appreciate, typically at the rate of inflation, but the actual mortgage stays the same, which is the largest line item in the expense side of the ledger. We love cash flow and passive income off of our deals, and that's what our investors like. That's why they invest with us, is getting that coupon every quarter is a really nice thing to see in your checking account. Again, there are tax benefits to real estate that other investment assets classes don't offer. You get depreciation write-offs, you get bonus depreciation. There's a whole litany of advantages from a tax side that other investment opportunities can't provide you with. Again, back to the economies of scale. If you can control in one acquisition 100 or 200 doors as opposed to buying 100 or 200 houses, you're going to spend a lot less time buying a 200 unit apartment building than you are 200 houses. So you're now leveraging your time in the deal. There's that word again, leverage. As a consequence, it's a hedge against inflation. You're locking in a lot of your costs at the beginning of the deal, and you're getting cash flow and appreciation and increase in rents. So you're getting increased cash flow in an inflationary environment. So it's a hedge against inflation. And finally, as a country, we are millions of units behind schedule in housing production. It is the reason why you're seeing such, an increase in rents and home values is we've had 3 major economic events in the last 13 years, taken housing production off for 5 or 6 years of those in that time frame. And, we're seeing the consequences of some bad luck and some bad policy starting to really rear its ugly head. So who knows where this is going to end? All I know is I'm going to keep buying apartments and making returns for my investors. So, all right, now, let's talk about this elephant in the room. As I said, I invest in these deals myself. I've invested in other deals. What do I mean by the elephant in the room? In the conversations I have with potential investors, there's always like 1 or 2 questions that always comes up. And, and even though a lot of deal sponsors out there will promise the sun, the moon, the stars, with all these huge returns, the first question I want to know when I investigate an opportunity is, how am I going to get my money back? Which is, I think any smart investor, that should be the first question you ask. If you partner, if I'm going to partner with you, how do I get my principal back? What's the mechanisms that you have in place to actually protect my downside risk? And if, everything goes to, hell in a handbasket, what's my ultimate risk on this deal? So, we're going to address that here shortly, but, I want to acknowledge that we think about this a lot, and we structure our business model specifically to, address these concerns and mitigate the risk. So let's kind of name some of what these fears are that come up in these conversations that I have with investors. Investor fear number 1, they're always wondering if, what I offer is a Ponzi scheme. My typical reaction to that is Ponzi schemes are premised on fraud, whereas what we do is premised on, something entirely different. I can tell you that, we're not borrowing money from subsequent investors to pay new investors. Every deal is its own isolated little investment with its own isolated returns. So there's no way we can take money from one deal and shove it into another one. When you do hear about that, it is a really unusual event. That is a unicorn event that I can't say it hasn't happened, but I can tell you it's never going to happen with us. Investor fear number 2, which is, slightly more plausible, is, maybe the sponsor's cooking the books. Maybe the deal's not performing as well as they had hoped. Maybe they kind of blew something in their underwriting on the deal, and all of a sudden they're upside down on the deal. Rather than, just coming clean with their investors, they start cooking the books. Happens. Again, I don't know why investors would, or sponsors would ever go to a place like that. I'm of the temperament to always give people the straight, news, whether it's good or bad. So I can assure you that never happens on our deals. And then finally, what's probably the most plausible scenario in any of these deals is, avoidable mistakes. Avoidable mistakes can be avoided with experience. So really what you want to be vetting out with your deal sponsors is, do they have the experience? How many deals have they actually done? How do they troubleshoot deals when trouble happens? So anyways, let me conclude that, look, if you ask the right questions, and if you kind of really get a hint that, the operator, the sponsor that you're talking to doesn't come clean on any of this stuff, or you see any of these red flags, you really should run the other way. I, again, know that we go through great lengths to avoid this from ever being an issue in our deals. And, so far after 15 deals, we've never had a problem. But that said, it's not like there aren't challenges in this world of passive investing. And real estate is a tough game. It's really complicated, and you really have to have a lot of meat on your bones to be able to execute at a high level. So I want to go a little bit deeper into these challenges and, talk about them. You may have run into some of these in the past if you've invested in deals previously. And if you haven't, then, you're going to have some more red flags that you can use to vet sponsors with. And if you see any of them, you want to avoid these at all costs. So first thing is, lack of transparency. It drives me nuts that there are real estate sponsors out there who are not fully transparent with their investors, because that is how my whole business model is premised. I think I read somewhere that 86% of consumers say that transparency in business is more important than ever. And so, what is transparency? What does that mean? It means, being all about openness, clarity, and honesty. It's about communicating proactively. It's about providing timely answers to investor questions. And it's ultimately being, fully accountable to your clients and investors. What I will say is a lot of sponsors treat transparency and communication as an afterthought. And for us, that's not the case. We're going to go into that in a second. They may be late in distributions, may be late in issuing K1s. So anyways, if that's the case in deals that you're looking at, it's a red flag and you should probably, look elsewhere. Another investing challenge are principals who are hard to get a hold of. I know that we have communication protocols with our investors set up. We have a portal that provides timely, real-time communication 24/7 to all of our investors. Furthermore, I'm always only an email away, and I sit in front of this box all day long, so I'm very timely in my response to my investors. Take it very seriously. Other investors, sponsors may not, and I do know sponsors who are not as timely in their communication with their investors. Again, if that's the case in a deal that you were considering, it's probably a red flag that you want to avoid. That lack of communication. I just keep coming back to this. Communication is key in business, and it's certainly key in a business model where you are aggregating investor dollars for a large investment opportunity, and where we're working together as a team. So if you're not communicating with your investors, bad things happen. I always say that a lack of communication, provides a empty mind, and an empty mind will always go to a dark place. So I don't like empty minds. I like to be able to kind of just report with my investors about what's going on. If you are coming across a sponsor who isn't of that ilk, again, another red flag, you should be looking at something else. Delays in distributions is another one. We work very hard to always issue our distributions in a timely fashion. And if we've had one or two challenging deals, I'm not going to kid you, where, we weren't able to issue some distributions. These deals were born out of the pandemic. And it was a unicorn event, 100-year event, which really challenged us. But, we were able to communicate with our investors, let them know what was going on, let them know how we were going to kind of make up our distributions to them. And by God, we just did that about 3 weeks ago. We paid them all of the distributions they were owed in the deal up to that point. And we are now sort of back to where we were when we first took the deal under contract. So again, communication around distributions is key. Investors, number one thing they're interested in is their cash flow. They want their coupon. And so we take that very seriously. You know, in addition to distribution delays, there can be delays in issuing K-1s and tax reporting for the deal. We work very hard with our accounting firm to always get those out. You know, April is always a hairy month for us because we're doing 1,000 tax returns. So if you have a deal sponsor who isn't as fixated on getting that out the door is in a timely fashion like that, again, another red flag. You know, we do not like having our investors take extensions on their taxes. And excuse me, the K-1s are meant to be delivered much sooner than that, so you can do your taxes by April 15th. So we are very, always very timely in issuing those. Okay, so having gone through, you know, some of the red flags and challenges, let's talk about the SGRE advantage. You know, what it is we have created and why we think what we do is unique. We're, first of all, wanting to be the opposite of all these challenges that I've just gone over. You know, we are literally obsessed with our investors' experience, and we're fanatical about making sure our investors get the information they need in real time. In fact, we're so fanatical about it, we've written an entire mission statement around this. So anyways, I'm going to read this mission statement to you verbatim because I think it says everything pretty succinctly. So our mission is to provide a transparent investing experience where tenant and investor relationships come first while offering opportunities to provide the optimal combination of stable cash flow, consistent income, capital appreciation, tax benefits, and risk-averse wealth preservation. You know, pretty simple philosophy that we use is we always put our investors' interests ahead of our own. You know, the investors always get paid before anybody else. And, you know, it's a very effective way for us to stay focused on, you know, what we do and how we can create returns for our investors. Let's see here. So it also, you know, influences how we think about the business, you know, in order to follow through on that mission statement. We've built an entire business model that ensures that we can fulfill our promises. So, you know, the real advantage to our firm is that we've built this large vertically integrated organization. And there's a lot of reasons why we did that. But, you know, when I say large, we're talking about 110 people on the payroll right now. What we've done is we've brought all the property management and construction in-house. A lot of other deal sponsors and syndicators out there have to hire this out as third-party consultants, and you know, you're ending up paying a profit line item to these folks. By bringing that all in-house, we've eliminated that middleman, and you know, more importantly, we are controlling very tightly our labor and construction costs. It's you know, a very unique thing in the world of real estate investing. There are very few real estate investment firms out there that do it completely in-house and are as vertically integrated as we are. What this vertical integration allows us to do is we are able to deliver our unit turns at half the cost of our competitors. You know, that is just profit that goes straight to the bottom line and then is distributed to our investors. I generally think we're delivering 4 or 5 points to the IRR more so than our competition in all of our deals. And it's because of this vertical integration. Yeah, there we go. Then I had a bullet point around it. You know, not only does it allow us to deliver higher returns, it allows us to mitigate risk. You know, when I have a problem on a job site, I can just point and shoot, have one of my guys go out there. If I'm hiring a third-party contractor, it might be 2 or 3 weeks before they get out and fix a leaky toilet or something like that. So it allows us to deliver a better experience for our and our tenants, and also higher returns to our investors. Again, be a little redundant here, but the SGRE approach is premised on full transparency, quarterly reporting. You have 24/7 access to your investor portal. We always have timely completion of all our tax documents. And ultimately, what we're providing you with is a hands-off process and peace of mind. You could try to go out and do this yourself, but I have years of experience doing this. My partners have years of experience doing this. We have an entire organization built now to manage all of this process. You can try to do it. I've seen people try to do it, not nearly as successfully as we are. So what we're really offering you is return on investment. You invest dollars with us, we'll pay you a return, and investment, and in return for that return, we're giving you peace of mind. Talk a little bit about how we source our deals. Kind of have a unique process for that. We have a lot of broker relationships, as you can well imagine. We are routinely evaluating 40, 50 deals a week, and we're sourcing a majority of those off market. These are typically C-class deals that have a significant value add component. Value add just means that it allows us to renovate the units and put better finishes in there, and then capture higher rents than we would have captured otherwise. And that value add means that we're creating value where there was none before. It's also known as a forced appreciation model. Again, we've locked the price of the asset in at the beginning at acquisition. We underwrote the deal, understanding what our cost structure would be for the construction. Even in an inflationary environment, we're pushing the value of this thing north and delivering returns for our investors. So that's what a value add deal looks like. But you have to have a deal that needs to be renovated. So usually it's going to be a C-class deal built in the 80s. With a lot of deferred maintenance and operational challenges. We're going to be looking for a minimum of 200 to 250 units. We need that many to support the labor we put on a project. We are extremely conservative with our underwriting. Like I said, we underwrite a lot of deals, and because of that, we are saying no a lot more than we say yes. But what this allows us to do is cherry pick the best opportunities that we can then offer to our investors. Criteria that we typically look for is we like the Gulf Coast. We're based in Houston. We own most of our portfolio is Houston-based, but we also own up in Oklahoma. We own a deal over in Mississippi now. We're looking at deals all the way over to the Carolinas. We like MSAs with a minimum population of 250,000. Obviously, we're looking for business-friendly environments. I will never do another deal. Well, never say never, but I am averse to doing deals on the West Coast anymore because of the soft rent control that you experience all the way from Canada to Mexico. We're looking for diversified economies with a strong job growth component. The basic rule in the multifamily game is rent growth follows job growth. So wherever you're seeing environments that have a strong job growth component, you're seeing rent growth. We're looking for large pools of workforce candidates. They are typically the folks who inhabit our assets. And so we want to always have a large pool of potential renters out there who have easy access to transportation. So, roadways, freeways, light rail, bus lines, all of that is something we look for in every deal that we underwrite. And then finally, these deals, like I said, we're conservative and realistic in our underwriting. We target cash flow within the first year, typically the first quarter after acquisition. We're trying to issue dividends Those dividends are guaranteed APREF, so 8% annually, 2% per quarter. We're targeting a 20% IRR annually. On a 5-year hold, that equates to a doubling of your money, a 2 times equity multiple. That's our mantra. You place your money with us, we'll give you an APREF with a 20 IRR, and we'll double your money in 5 years. The investment targets, like I said, they're underwritten for 5 years. We tend to turn 8% or 5% of the units per month. The reason why we do that is we want to turn 100% of the units in 20 months and then season our cash flow so that by month 24, we can do a refi. And the refi is usually a cash out event. Again, this is another way we de-risk the deal for our investors. I've had several deals where between the first 2 years of cash flow and the refi event, we were able to hand our investors 100% of their principal back so that they are now 100% de-risked in the deal, meaning the last 2-3 years that we hold the deal, that's all just gravy profit. And then, of course, there'll be a sale event where they'll achieve their ultimate profit on the deal. So that's how, risk exposure is reduced. Giving people their money back, their principal back, doesn't get any better than that. We pay our dividends quarterly via EFTs or wire transfer. And as an investor, you will have 24/7 access to all of your tax documents via a portal on Juniper Square. So talk about some deal examples here. Green Tree Apartments, I'm just going to blow through these real quick. We acquired this deal in October of 2019. It was 196 units built in 73, debt of $13.3 million. Equity was $6.4 million. Had a construction budget just shy of $2 million with a guaranteed 8% preferred return and a projected IRR of 22.68%. And just over 2 equity multiple on it in 5 years. We ended up selling this deal early, sold it in May of 22. The NOI growth during that time frame was 39.46%, 23.6% on the IRR. Ironically, the cash on cash was the same, 23.6% on that one. We sold that one before the 5-year term. And I'll tell you why in a minute, because it was sold at the same time as this deal, which is Ridge Point. That's in Houston as well. Again, we acquired this one. This one was acquired in January of 2020. 168 units built in 1980. Debt of $11.66 million. Equity $7.187 million. Construction budget of a little north of $2.25 million. Again, a preferred return of 8%. We had a projected IRR of 19% on this one with equity multiple, again, just over 2 in 5 years. We sold this one same time as the last one, May of 2022. The NOI in this one just screamed. It was a 340.86% increase in the net operating income on this deal. IRR was 21.7, 23% actual cash on cash to the investor. So what was unique about these 2 deals is we sold them at the same time, plus a third one. And they were all sold in less than 3 years, I believe. What that allowed us to do is 1031 all of our investors into another deal that we had right there. This is kind of getting a little complicated, but what we also look at is the velocity of money for our investors. By utilizing a 1031 strategy into another deal that we had waiting, our investors were able to realize profit on 2 deals within the same 5-year time frame. The IRR, the cash on cash, all rise as a consequence. the equity multiple goes from like a 2x equity multiple up to anywhere from, I don't know, 2.4 to 2.7. We won't know until we go full cycle on the next deal, but it's a way for us to turbocharge returns to our investors, again, while mitigating risk. So finally, we're getting down to the partner opportunity. So we've talked about our specific strategy, process for finding deals, the potential upside, how we protect the downside, and ultimately what this can mean for our potential partners. So let's talk about that. Our track record is we currently own 3,000 units. We now have over 1,000 investors across 15 deals. Knock on wood, each deal has so far outperformed all of our initial projections, even the ones challenged by the pandemic. We've always issued our quarterly reports and K1s on time. We have personalized deal access through Juniper Square, and we're very investor centric. We are very, very fanatical about putting our investors' interests ahead of our own. So that makes you more than just a number. The opportunity that we offer is it's a hedge against inflation. You're going to experience less volatility and risk than the stock market. Again, my favorite word is leverage. You're going to be able to utilize leverage in your investment portfolio now. You're going to realize tax advantages. You're going to get consistent returns. And all of that, is acquired for a $25,000 minimum investment. All of our deals are 506B deals instead of 506C, which means, they're both open to accredited and sophisticated investors. So, if this is something that sounds interesting to you, the best way to get involved is to join our investor club. How you do that is, you can set up a consultation, and we'll talk about the opportunity further. This is a chance for each of us to get to know one another, answer any of your questions. The way you go ahead and get involved is you can book a consultation with me. This consultation is no obligation. I am not a salesy kind of guy. But what I do like to do is find out more about you and find out about your investment experience. We can talk a little bit more about the potential opportunities that we may have. We can talk more about tax benefits. We can talk about timing, whether it's a good time for you or now or in the future. Ultimately, what we're trying to do is establish a relationship. The SEC requires me to have a pre-existing relationship with all of my investors. So this conversation is a great way to get that ball rolling. At the end of the conversation, if it seems like we're on the same page or it's a good fit for you, I'll invite you to become a member of our club. Puts you on the investor list so that you have access and first access to all of our deals. All of our deals are first come, first serve. And they go fast. They fill very, very quickly. I've had deals fill in less than 24 hours. So there is a big advantage to being on the mailing list for our deals. So anyways, to book your consultation, it's real simple. Just go to sgreinvestments.com/consultation. There'll be a little form there that I'll ask you to fill out. I know kind of the stereotype about filling out forms and giving up your information. I promise you I'm not that guy. But what it does do is give me some of your background before the call so that I can understand who you are as we get into the call. It's just more efficient for me to do that. And really, it's no obligations. So again, just go to sgreinvestments.com/consultation and book yourself an appointment. If you have any questions outside of that consultation or beforehand, feel free to hit me up. Info@sgreinvestments.com is how you can get a hold of me. I'm always in front of this box and really look forward to talking to you. Don't care if it's just one-off questions or investors coming or questions coming out of this presentation. I love talking about this stuff and kind of a real estate junkie. So anyways, info@sgreinvestments.com. Thanks for attending today's webinar. I look forward to speaking with you and have a great rest of your day.